All right, good afternoon, everyone. It's 12 o'clock on the nose, so we're going to begin. Good afternoon and welcome, everyone. Welcome to the forum that we have today. It's entitled The Racial Bias in the Home Appraisal Process. Today's event is hosted by the District of Columbia's Department of Insurance, Securities, and Banking, also referred to as DISB, in partnership with the Consumer Financial Protection Bureau, also known as CFPB, and in alliance with our sister agency, DCRA, the Department of Consumer and Regulatory Affairs. My name is Monique Carr. I'm a manager here in the Banking Bureau at DISB and a member of DISB's Banking Bureau's Subcommittee on Diversity, Equity, and Inclusion. The subcommittee consists of 6 other DISB staff members, Mia Cole, Maureen Marat, Leonard Smith, Bedford Collins, and Samuel Fuller. Our aim this afternoon is to provide you with information on appraisal bias, the history of it, the current manifestation of it, and the steps that you can take if you feel that you've been impacted by appraisal bias. I will be the moderator for the presentation segment of this event. Before we begin, we would like to thank Mayor Muriel Bowser and our Commissioner, Karima M. Woods, for creating a space to allow us to do this very important work. A little bit of housekeeping before we begin. The forum is scheduled to run until 1:30 p.m. The presentation is being recorded and will be available for playback on our website, DISB's website, in about 48 to 72 hours. Currently, all participants are in listen-only mode. Please know that we're using the chat feature to capture your questions. And also, if you need to communicate with one of the panelists, you can, again, use the chat feature to ask a question or to contact us. At the conclusion of the presentation, we will begin our Q&A segment. So again, feel free to drop your questions in the chat feature. At that time, one of the DISB staff members will actually read your question aloud. If you're joining by phone, please press *3 to raise your hand and we will work to get your question. At this time, I would like to introduce our Commissioner, Karima M. Woods, who will provide the opening remarks. Commissioner?
Thank you, Monique, and I hope you all can hear me loud and clear. We are very, very excited to be having today's conversation and knowing that it is a series of a number of forums that we plan to hold addressing racial bias in the home appraisal process. I greet you this morning. I am Karima Woods, this afternoon. I'm Karima Woods, Commissioner of the District's Department of Insurance, Securities, and Banking. And we're very excited about today's discussion. Monique has identified a number of our key partners, so I just want to reiterate and thank the Consumer Finance Protection Bureau and the District's Department of Consumer Regulatory Affairs for their participation and support on this very important topic. I also want to recognize Monique and her work in leading this effort. Also want to thank Samuel Fuller, our Associate Commissioner for Banking at the department, and the colleagues of the Subcommittee for the Diversity, Equity, and Inclusion Subcommittee at DISB. Thank you, Miriam. Thank you, Thedford. Thank you all for your work and for helping us to put this together. And thank you, Maureen, as well. So a little bit about the department and why we are taking on this very important topic. At the Department of Insurance, Securities, and Banking, we are the district's chief financial regulatory agency. We're charged with overseeing the financial service entities that impact the lives of residents and businesses here in the district. The department, as well as the mayor, and I do want to just thank the mayor for her strategic investments and placing an important emphasis on this work and on all things related to affordable home ownership here in the District of Columbia. So the department is fully committed to supporting the mayor's goals around advancing equity, diversity, and inclusiveness in the financial services industry. We are directly working to tackle the economic barriers to opportunity by expanding inclusive access to financial resources and services in the district, particularly on topics that impact home ownership. This is a part of our charge as an agency. We have a focus around financial education and empowerment, and so it's important for us to support our residents around all things related to their financial affairs. And we know that home ownership is one of those important aspects of one's financial affairs. And so we really see today as a catalyst for these efforts. This is an ongoing conversation, and we encourage you to participate in it and share your feedback and or experiences with our department. We recognize at the department that throughout the 20th century, people of color have been historically denied equitable access to housing as federal, state, and local governments systemically implemented discriminatory policies that led to housing segregation, including policies like redlining. We also recognize that these policies have contributed to a significant gap between the values of homes in communities of color in comparison to predominantly white neighborhoods. Even though the Fair Housing Act was designed to ensure equal opportunity for home ownership, we unfortunately continue to see fair market value disparities persist and are a significant factor in today's expansive racial wealth gap. There is substantial evidence out there of racial disparities in home appraisals, which are resulting in the undervaluation of homes in non-white neighborhoods. It's critically important that homes are valued at their true value as it contributes to building and transferring wealth within one's family. This evidence has been further ignited, a nationwide conversation, if you will, amongst homeowners, advocates, regulators, and the industry as we take a critical look at addressing these issues related to systemic bias in the appraisal process. So today's forum is really the beginning of that conversation as the department looks to educate our fellow residents on the history of racial bias in home ownership, how it shows up in the home appraisal process, and action steps that you can take if you've been impacted by racial bias in your home appraisal process. At the department, we have a robust consumer service unit that provides support for district consumers who have complaints with their financial services providers. We do encourage you to visit our website at disb.dc.gov to learn more about our consumer complaint process and additional information about all of our financial education and empowerment programs. With that, I again want to just thank you for attending today's virtual forum. We're hoping that as a result of this forum, you'll be better informed and equipped to challenge an undervalued home appraisal should you or someone you know receive one. With that, I know that my team will also add their contact information in the chat for you. So if you have any questions in follow up to this panel, please feel free to reach out to my team directly, particularly Monique Carr. I'll turn things back over to you, Monique. And again, thank you for your support and leadership in putting today's forum together.
Thank you, Commissioner. Thank you for your leadership and your remarks on today. I would like to now introduce our first presenter. We do have a content-heavy presentation, so we're going to go into our presenters. Our first presenter is Mr. Charles Nair. Charles Nair is a senior counsel with the Consumer Financial Protection Bureau and works on fair lending matters. Prior to his employment with the CFPB, he worked as a supervising attorney with the Pennsylvania Human Relations Commission. Mr. Nair has published a number of legal and historical civil rights articles and graduated from Ohio University with a BA, from the Dickinson School of Law of the Penn State University with a JD, from the Georgetown University Law Center with an LLM, and from Temple University with a PhD in history. Dr. Nair will start us off by providing the origins of appraisal bias. Dr. Nair, the mic is yours.
Great. Thank you, Monique. Thank you for the introduction. And what I would like to discuss today and frame our conversation for a discussion of appraisal bias is in the historical origins of redlining, appraisal bias, and the devaluation of Black communities and its relationship to the Black wealth gap that we see here today. I think it's really important to understand sort of the deep historical and systemic factors that have driven the Black wealth gap and how they relate to redlining and appraisal bias. Next slide, please. Quick disclaimer here. This presentation is being made by the CFPB representative on behalf of the Bureau It does not constitute legal interpretation, guidance, or advice of the CFPB. And any opinions or views that I state today are my own and do not necessarily represent the Bureau's views. Next slide. So with that, let's frame it up here with talking about wealth in the United States and what that means. So wealth is the total extent of an individual's accumulated assets less any debt. And that basically is your wealth total. And I think, as everyone knows, wealth has a huge impact on all sorts of life opportunities in the United States. It impacts our education, our housing opportunities, employment, social capital, intergenerational transfers of wealth. And in many ways, I think wealth is the single best indicator of racial inequality in the United States. Next slide, please. And what we have here in the United States is a tremendous racial wealth inequality. The Federal Reserve recently released updated racial wealth data from a 2019 survey of consumer finance and found that the African American households had a median net worth of about $24,000 with a mean of about $142,000. In comparison, white households had a median net worth of $188,000 and a median net worth approaching $1 million. So about an 8-fold difference between Black households and white households in terms of wealth accumulation, which in turn affects all those additional opportunities that I just mentioned. So it's a huge disparity. And I'd like to now sort of pivot to understanding what has created that, and how does redlining and appraisal bias fit into the broader historical narrative that leads us to these statistics that we're seeing here today. Next slide. So I think the single most important means of accumulating wealth for most families in the United States is home ownership. And as of the fourth quarter 2021, the home ownership rate gap between African Americans and whites stood at 31.3%. That's really a historically high number. In fact, that number, that wealth gap of 31, or that home ownership gap of 31%, actually exceeds the gap that existed prior to the passage of the Fair Housing Act, when it was actually legal to discriminate. So a really astounding number in terms of the home ownership gap we find ourselves with today. And that gap has been quite durable and consistent throughout the 20th century. It has exceeded 25%. And historically, right now, it is at near record levels. Next slide. And in fact, one recent survey found that if you eliminated that disparity in home ownership rates, in other words, if African Americans and whites owned homes at the same rate, that would eliminate up to potentially 31% of the racial wealth gap. And if you added on to that equalization of home equity gains between African Americans and whites, that would further eliminate the gap another 16%. So home ownership and appreciation and valuation of homes is really driving a huge chunk of the racial wealth gap. Almost 50% is attributable to home ownership. So it's a huge factor in sort of the overall wealth gap in this country. Next slide. So one explanation for the wealth gap is the racial home ownership gap. And since few people have the actual financial resources to purchase a home, most folks resort to financing. And a key component to achieving home ownership then is fair and equitable credit. However, African Americans have historically faced widespread discrimination in the credit markets, including in the form of appraisal bias. And one of the main areas of discrimination is the practice of redlining, which is defined as mortgage credit discrimination that's based on the racial or ethnic characteristics of the neighborhood surrounding the would-be borrower's dwelling. So it's really driven by geography and overall racial composition of neighborhoods in the allocation and access to credit. And within redlining is the notion of appraisal bias. So with that, I'm really going to now dive into the history and going to spend a fair amount of time talking about it because it's really sort of deeply embedded in a systemic way in the broader financial markets in the United States. So next slide. So let's go all the way back here. Since the founding of the United States, there's been a strong negative correlation between race and property values. And in many ways, it's been a core pillar of racial discrimination in this country. And you see going all the way back to 1793, where we had George Washington was the president at that time. And a young man named Eli Whitney had filed his patent for a unique invention known as the cotton gin, which is, of course, is going to revolutionize cotton production and greatly increase slavery in the United States. So in 1793, a white minister protested an attempt to locate a Negro hut in Salem, Massachusetts. And he noted that that would depreciate property value, drive out decent residents, and injure the welfare of the neighborhood. So you already see as early as 1793, this connection, this nexus between race and property value. Moving forward a little bit further in 1850, about 11 years before the Civil War breaks out, a white resident in Indiana complained that establishing, quote, a Negro tract of real estate would reduce the value of white-owned lots by at least 50%. And then in 1899, W.E.B. Du Bois, the famous civil rights leader, explained that public opinion in the city of Philadelphia is such that the presence of even a respectable colored family in a block will affect its value for renting or sale. So these are just a couple examples in the historical literature that show this discriminatory belief that African Americans or African American neighborhoods will have a negative impact on property values. And it's not sort of a new concept. It dates all the way back really to the founding of the United States. Next slide. So I want to fast forward to really how then this concept, this discriminatory concept then becomes embedded in a systemic manner in the appraisal process as well as the practice of redlining. And it really starts with the Great Migration, which intent on escaping the violence and discrimination of the South. Millions of African Americans leave the South for the urban cities of the North, Midwest, and West, looking for economic and educational opportunities. And you can divide the Great Migration really into two different time periods, really centered around the First and Second World War. So the Great Migration, the original Great Migration, we have about 1.6 million people arriving in the cities, primarily in the Northeast, leading to huge population increases. For example, if you look in just 30 years in New York City, the African American population increased from 140,000 to over 650,000. And the second Great Migration, which was really driven sort of in large measure by World War II and the creation of job opportunities in the North, expanded the geographic reach of the Great Migration. Not only was it to the cities of the Northeast, but it also expanded really to the Midwest in the West. And you see some statistics there for Los Angeles and San Francisco, with just tremendous population growth, increasing tenfold in just 30 years. And in fact, this is the largest internal movement of any group in American history. And in many ways, the African American population in the United States changes from one that was primarily rural and located in the South to more distributed throughout the country in the urban areas across the entire spectrum of the United States. Next slide. This is just a little image here of what these migration patterns look like, where you see thousands and thousands of people leaving the South, heading to cities in the North, Chicago, Detroit, Baltimore, Philadelphia, New York, and exiting the South, which resulted in huge population increases in the North, in many urban areas. Next slide. So as African American migrants are moving north, one of the things that they brought with them is the continued desire for home ownership. And the home ownership system that was in place in the early 20th century was much different than sort of the mortgage system that we have in place today. Mortgages typically required a large down payment. You usually had to put down almost half of the purchase price, and the remainder was financed with what at the time was called a straight mortgage. And basically, that resulted in 2 to 6% interest rates, with fees ranging from 3 to 6% of the loan. But it was for a 5-year term. It was what we would call today an interest-only loan, with a balloon payment at the end, which would mean it would have to constantly be refinanced. Often borrowers had to take out a second mortgage because the down payment was so large on a purchase. And those came with higher interest rates and higher costs. And they were also, again, for short terms, which required repeated renewal with additional fees. And sometimes borrowers even had to use third mortgages to cover all these fees, as well as some of the first payments on the first and second mortgage. So the system itself of obtaining home ownership was quite challenging for all people in the United States. But African Americans were presented with even additional obstacles. Next slide, please. So banks often simply refuse to lend to African Americans. And even if a bank would make a mortgage loan, often the terms and conditions were much more onerous as compared to white borrowers. And typically, African American borrowers were charged interest rates and fees at least double those offered to whites, assuming they could even find a financial institution that was willing to lend to an African American borrower in the first place, which was a challenge. And I see included a quote here from Raymond Pace Alexander, who is a very prominent African American lawyer in Philadelphia. And he explained that, quote, if a colored man owns City Hall, he would be unable to get a first mortgage on it at this bank. They absolutely refuse to lend money in any manner to Negroes. I think this quote really sort of captures the widespread discrimination that would-be African American borrowers encountered when trying to obtain a mortgage to purchase a home. Next slide. And in many ways, at this time period, it was basically a hands-off approach from the federal government to housing policy. The federal government had very little role in real estate, in home ownership, in anything of the sort. But that all changed really in October 1929 with the collapse of the stock market, which triggered the Great Depression. And with that, over 5,000 banks closed in just a 4-year time period. $7 billion in depositor funds vanished. Housing construction virtually stopped. And by 1933, 1/2 of all mortgages in the United States were in default, with foreclosures running about 1,000 per day. Now, in response to this, the federal government begins to get involved and essentially revolutionizes housing finance to rescue the market and also to make home ownership more accessible to Americans, given how difficult it was under the prior mortgage financing system. But unfortunately, the system the federal government introduced to support home ownership placed discriminatory barriers in the path of African Americans. And really, the first and foremost were really the practice of redlining and the role of appraisal bias within the practice of redlining. So I'm going to turn to that now. Next slide, please. So it started with what is somewhat of a rather obscure governmental agency that no longer exists today, but it was the Homeowners Loan Corporation, which was established to help families in danger of foreclosure by basically refinancing their delinquent mortgage. And it was tremendously successful. It supplied over $3 billion for over 1 million mortgages in just a couple-year time period. 40% of all qualified mortgagees sought its assistance. And it revolutionized financing by, for the first time, providing a 15-year term mortgage that was fully amortized, meaning it was paid off at the end of its term, at a reasonable interest rate of 5%. So no more second, third, first, second, third mortgages anymore. We had a single mortgage amortized with a realistic interest rate. But since the HOLC was dealing with mortgages in default and the government was refinancing these mortgages, it introduced really for the first time standardized appraisals of properties in communities in order to assess possible risk. Now, certainly appraisals had been around for a while, but what was different about the HOLC was the standardization of the process. And as historian Kenneth Jackson explained, the HOLC created a formal and uniform system of appraisal. It's reduced to writing, structured in defined procedures, and implemented by individuals only after intensive training. So, in other words, it really, for the first time, professionalized the appraisal industry by setting forth standard practices, procedures, defining it in writing in a very sort of systemic way. Next slide. And in doing that, in developing these standardized appraisal practices, the HOLC was heavily influenced by urban and neighborhood development theory, which was driven by just a small handful of academics and real estate professionals. And they're really providing sort of the intellectual and structural foundation upon which appraisal bias and redlining was ultimately built. And one of the chief proponents of this was Frederick Babcock, who was a Chicago real estate appraiser and came up with the ecology theory of gradual but inevitable neighborhood decline. And basically what he meant by that, as more people arrive, successive waves of residents arrive, the neighborhood will continually decline until it's occupied by the poorest, most incompetent, and least desirable groups in the city. And he wrote a very influential book. And one of the things that he explained here, and what makes this relevant, is among the traits and characteristics of people which influence land values, Babcock explained that racial heritage and tendencies seem to be of paramount importance. In other words, he placed race at sort of the center of the valuation process of real estate. And he explained it in quite vivid detail in this manual published in 1931. He said most of the variations and differences between people are slight, and value declines are, as a result, gradual, which was consistent with his overall theory that over time, neighborhoods decline. But he had one important caveat to that. He said that there is one difference in people, namely race, which can result in very rapid decline. And he went on to say and advocate, usually such declines can be partially avoided by segregation, and this device has always been in common usage in the South, where white and Negro populations have been separated. So Babcock is really sort of formulating the intellectual foundations and the nexus between race and property valuation, and then tying it into the importance of segregation for maintaining property values. Next slide. And later, Homer Hoyt will build on this. He's another, again, very prominent real estate appraiser and economist. And he took Babcock's work even further. And he developed what was called the filtering or trickle-down model, again, which suggested that as properties in neighborhoods got older, they filtered down to poorer and less capable persons until they basically became slums. And again, just like Babcock, he incorporated into his theory notions of racial valuation. And he explained, part of the attitude reflected in lower land values is due entirely to racial prejudice. He went on to say, that might not have any reasonable basis, but that the fact of the matter is racial prejudice was driving lower land valuations. And he explains that nevertheless, if the entrance of a colored family into a white neighborhood causes a general exodus of white people, such dislikes are reflected in property value. So again, he's building on Babcock's work to continue to argue that it's racial prejudice that is driving property valuations as sort of the intellectual foundations to support appraisal bias and redlining. Next slide. So Holt's work also included a rather sort of infamous list of most desirable to those with the most adverse impact on property value. So he actually included in his work is this list, with English, German, Scotch, Irish, Scandinavians viewed as having the most positive impact on property values. And at the bottom are Negroes and Mexicans. He explained, he's basically trying to caveat his analysis a little bit, fully understanding, I think, of what it meant by explaining while the ranking may be scientifically wrong from a standpoint of inherent racial characteristics, it registers an opinion or prejudice that is reflected in land values. So he's quite cognizant of the fact that prejudice and racism is driving this racial valuation of properties. He even acknowledges it may be scientifically wrong, but at the same time, he admits that it is racial discrimination that's driving property valuation differences. So next slide. So why does all that matter? These are kind of obscure historical figures, but their influence is quite broad here. And we begin to see that in the HOLC City Survey Program. And this was basically an attempt by the HOLC to assess real estate risk all across the United States in 239 cities. And they did this by distributing questionnaires to local real estate professionals, mortgage lenders to measure risk. And they sent out thousands of these questionnaires. But in the process of sending out these questionnaires, they included notions of ethnic and racial worth as a key component for measuring risk. And in fact, arguably, no factor was more important for appraisal purposes than race. For example, the HOLC, as part of this risk assessment, monitored the movement of African Americans and also charted the density of African American neighborhoods. And you can see this in some of the forms that were distributed by the thousands. So next slide. I know this is a bit hard to read, but this is an example of what those questionnaires looked like. And they had very sort of explicit questions about race. For instance, one of the questions was, are there any detrimental influences? And in this particular survey, which was for Dayton, Ohio, it indicated mixture of Negro and poor white. It had a specific question about infiltration. And on this questionnaire, it was entered, quote unquote, Negro. And then it also indicated or asked whether there was any, quote unquote, Negro population. And if so, what was the percentage of that? So in this particular form, it said yes, and 80% of this particular area was African American population. And based on that, included at the bottom of the form is a clarifying remark, which rated the overall neighborhood as low red. And what does that mean? So next slide. So low red, that really sort of has the origins of what the term redlining means and where it came from. Because the survey program compiled all this information, all these questionnaires were then basically developed into 4 coded color categories of risk. All the information was boiled down into 4 simple categories. The first being A, which are coded green. These are the best areas, always in demand, in good times and bad. The next category of risk was blue. These had reached their peak, but were still desirable. Then you had C, which were coded yellow. These were areas that were definitely declining. And finally, you had D, which were coded red. These were deemed hazardous areas, characterized by detrimental influences of a pronounced degree, undesirable populations, or an infiltration of it. And that's where the term redlining comes from. This color-coded map scheme, where you had neighborhoods coded red and were essentially deemed the highest risk for credit. Next slide. And invariably, given sort of what we talked about, sort of the structural roots of appraisal bias and redlining and this notion of valuation in race, African American neighborhoods were almost always rated 4th by the HOLC, were coded red, and were redlined. For example, in Detroit, every neighborhood with any degree of Black population was rated D or hazardous by federal appraisers, meaning it was the highest level of potential risk. And then following completion of the rating system, the HOLC prepared color-coded security maps that detailed these various real estate risk grades. And these have got a lot of attention and publicity of late, and probably folks are familiar with these maps. They were largely forgotten until a historian came across these in the National Archives in DC in the 80s. And I'll show you a few images of what these maps look like. Next slide. This shows you what these maps look like. And this is a map of Atlanta, where you can see sort of the various gradations: red, yellow, blue, and green, with the red areas corresponding to the African American population, concentrated in the core of some of the urban areas of many cities across the United States. Next slide. And this is Los Angeles. The University of Richmond has actually digitized all these maps. So if folks have any interest in digging into this topic a little bit further, I urge you to check out the digitization of these maps, which then sort of provide individual descriptors of what was in those questionnaires on all of these neighborhoods across these maps. Next slide, please. So overall, the HOLC, it did have a surprising mixed record of mortgage lending in neighborhoods coded yellow and red. But nevertheless, African Americans were still subject to discriminatory practices. First of all, if you did get a loan in a D-rated neighborhood, it usually came with a higher interest rate. It also reinforced segregation by refusing to sell and make loans to African Americans for properties in white areas. And it often routinely underappraised the value of African American areas. But really the major damage of the HOLC was it basically adopted, elaborated, and implicitly placed the federal government's seal of approval upon this notion of real estate value in race. And in turn, this system was adopted by private financial institutions, which institutionalized in a systemic way the practice of racial redlining, and with it, discriminatory bias that was inherent and at the core of racial redlining. Next slide. But perhaps its broader impact really comes with the Federal Housing Administration, which is still around today, obviously, and it has a much greater impact than the HOLC. It was established in 1937 to continue sound home financing on reasonable terms and conditions. The FHA doesn't directly lend money. It basically insures up to 90% of any loss incurred by a private lender for an FHA approved mortgage. And it's tremendously successful. You see that in some of these statistics with housing starts exploding from 332,000 to 619,000 in just a few years. And by the end of 1972, the FHA has assisted over 11 million people achieve home ownership. So a very, very successful and long-term program that still exists today. But it came at a price, as FHA financing in white was largely occurring in white areas in the suburbs, to the detriment or exclusion of African Americans residing in urban areas. And why was that? So next slide. Well, the reason for that is both Howard Hoyt and Frederick Babbitt, who I talked about earlier, who really provided some of the intellectual foundations of this, they joined the FHA after its founding and worked to develop its appraisal and underwriting practices. And like the HOLC, the FHA required an unbiased professional estimate as a prerequisite to any loan guarantee in order to ensure the value of the property would exceed the outstanding mortgage debt, which is certainly quite reasonable. If the federal government is going to insure a mortgage loan, they want to make sure that the property is worth the amount of the loan. The problem again is that acting on the HOLC's rating system, the FHA developed even more elaborate advice on race and real estate value for its appraiser in its underwriting manual, which basically set forth sort of the credit criteria for deciding whether to approve or decline a mortgage application. Next slide. And this is just a brief excerpt from the FHA underwriting manual, where you see very clearly sort of the impact of Babcock and Hoyt in this notion of a negative correlation between race and real estate value. They say if a neighborhood is to retain stability, it is necessary that properties shall continue to be occupied by the same social and racial classes. A change in social or racial occupancy generally leads to instability and a reduction in value. It warned about the infiltration of inharmonious racial groups and nationality groups. And to avoid this infiltration, it recommended the use of basically restrictive covenants as an excellent tool to maintain neighborhood stability. A racially restrictive covenant was a paragraph or language contained in a deed which prohibited the sale of a particular property based on sort of racial groups. If folks live in an older home in an urban area, it's quite possible that their deed could actually contain a restrictive covenant, and you probably wouldn't even be aware of it. Ultimately, the Supreme Court strikes those down as unconstitutional. But again, the damage in some respects had already been done. But the core of it, the entire FHA appraisal process, is based on this premise that racial segregation is necessary to ensure property valuations. So segregation and discrimination become inextricably linked to valuations of property under the FHA's sort of mortgage lending underwriting manual. Next slide. And again, just like the HOLC, this becomes adopted and institutionalized by private financial institutions. As late as 1951, the McMichael's Appraising Manual, which is considered the Bible of appraising, it actually included Hoyt's ranking that I showed you earlier in the presentation of the racial and ethnic groups in order of most desirable to those with the greatest negative impact on property valuations. That was included in the manual as late as the 50s. And we see that in what was actually happening. For example, in Chicago, a survey of 241 savings and loan institutions found that only 19 were willing to make loans to African Americans who were willing to buy homes in Black areas, and only one was willing to grant a mortgage to African Americans moving to a white neighborhood. So again, this notion of segregation as being central to property valuation, and this central to the extension of credit in the appraisal valuation process is systemically incorporated into our mortgage markets. And you see that in a quote really from Maximilian Martin, who was a real estate expert in the Philadelphia area. He said, quote, "Today, however, a very undecided bias exists on the part of mortgage lending agencies. Upon learning the racial identity of the applicant or finding that the property is occupied by colored people, the loan is often immediately rejected without further investigation." Next slide. So what's the impact of the FHA? So let me give you a couple examples here. So in Detroit, we have a developer proposing an all-white subdivision. It's an all-white subdivision. It just happened to be next to a Black neighborhood in the 8 Mile, Wyoming area of the city, which had been rated D or hazardous by the HOLC, in effect defined as a red line neighborhood. The FHA denied the developer financing, not because he was planning to sell to African Americans or in any way integrate the neighborhood, but just due to the fact that it was close to a Black neighborhood. And as a compromise, the FHA agreed to provide the mortgage loan guarantees for the development, provided the developer build a foot-thick, 6-foot-high wall for a half-mile to separate white and Black neighborhoods. And you can see that in this picture here in the background is a picture of that wall. And that just shows the incredible extent to which the financial industry and development industry would go to ensure that segregation was maintained, given its core relationship to the discriminatory nexus of valuation and race. Next slide. Here's another example here of the Dixons who they had purchased an empty lot in Cleveland Heights in Ohio. And they wanted to build a home, and they had got a letter from a bank talking about FHA financing. And after they received the letter, they visited the bank. During the meeting with the bank's mortgage specialist, he openly admitted, quote, "There's no need in me kidding you, Mr. Dixon. Taking your money for appraisal fees, the bank's loan committee would reject his mortgage loan application." The mortgage agent later revealed confidentially, it is the policy of the bank not to loan money to Negroes under any circumstances. So that gives you two sort of examples here, and these are sort of broader now statistical numbers. The data is a little bit mixed in terms of the ability to analyze it, but here's a few examples. So in Northern California, you have 350,000 homes constructed with FHA financing right after World War II. Of those 350,000, less than 100 were for African Americans. And the same is true in Philadelphia. A statistical analysis of mortgage lending concluded that the FHA policies virtually guaranteed that few homeowners in these areas would be the beneficiary of FHA insurance. And overall, from 1930 to 1960, which incidentally is the period where American home ownership increased percentage-wise in the greatest fashion, particularly after the Second World War, where home ownership really just exploded, and we have the development of home ownership and the development of white suburbs. Scholars have demonstrated that fewer than 1% of all mortgages in the nation were issued to African Americans. So tremendously impactful, and it ties in this sort of notion of valuation in race in the context of redlining and the appraisal bias that was inherent in that process. Next slide. So in conclusion, I think one of the primary explanations for the large racial wealth gap is this historical and structural discrimination in the credit markets, including the practice of redlining, which in turn was really driven by appraisal bias. Redlining was driven by external factors, the actions of the federal government, which then became embedded in a structural way that limited access to traditional sources of mortgage credit for African Americans, and in turn resulted in the devaluation of African American communities. And in many ways, I think we still see, obviously, the residual of these historical practices in contemporary issues of appraisal bias, and also its relationship to the overall racial wealth gap in this country. Next slide. I think I have some sources if folks are interested in following up or doing any additional research. These are listed some of the sources I relied on for this presentation. And with that, I appreciate the opportunity, and I hope folks found this informative.
All right, thank you so much, Dr. Nair, for that informative presentation. We always enjoy hearing your presentations here at the agency, so thank you again for joining us today. At this time, I will introduce the next presenter, Ms. Makilia Griffith. Makilia Griffith is a fair lending counsel with the Consumer Financial Protection Bureau. Ms. Griffith joined the Bureau after experience in the private sector as a financial services attorney. She's a graduate of Villanova University and the George Washington University Law School. I will now pass the mic over to you, Ms. Griffith. The floor is yours.
Awesome. Thank you very much for having me here. Before we begin, I'd like to provide a disclaimer about the material that I'm presenting today. The presentation is being made by a Consumer Financial Protection Bureau representative on behalf of the Bureau. It does not constitute legal interpretation, guidance, or advice of the Consumer Financial Protection Bureau. Any opinions or views stated here today are my own and may not represent the Bureau's views. So when a home is improperly valued by an appraiser, it hurts not only the homeowner, but the surrounding community. Systematically low valuations, driven by biased appraisals, may exacerbate existing disparities in the housing market. Both under and overvaluation negatively impact the ability to build wealth through homeownership. Undervaluation of homes can result in the consumer being denied access to credit, for which the consumer is otherwise qualified or offered credit at less favorable terms. Overvaluation of homes can also put family wealth at risk and lead to higher rates of foreclosure. Next slide, please. So now we're going to talk a little bit about the PAVE task force. On June 1st, 2021, President Biden announced the creation of an interagency initiative, the PAVE task force. PAVE was formed to create an equitable path toward addressing the persistent misvaluation and undervaluation of properties experienced by families and communities of color. 13 member agencies and offices make up the task force. These member agencies and offices include the U.S. Department of Housing and Urban Development, the White House Domestic Policy Council, the Appraisal Subcommittee, the Federal Reserve Board, the Consumer Financial Protection Bureau, the Federal Deposit Insurance Corporation, the Federal Housing Finance Agency, the National Credit Union Administration, the Comptroller of the Currency, the U.S. Department of Agriculture, the U.S. Department of Justice, the U.S. Department of Labor, and the U.S. Department of Veterans Affairs. Next slide, please. So this task force was directed to evaluate the causes, extent, and consequences of appraisal bias and to establish a transformative set of recommendations to root out racial and ethnic bias in home valuations. The task force engaged various stakeholders to evaluate the causes, extent, and consequences of appraisal bias. These stakeholders included various philanthropic organizations, academics, civil rights leaders, housing industry stakeholders, and everyday Americans who currently own or aspire to own a home. Next slide. On March 23rd, 2022, HUD and the White House released PAVE's final report titled The Action Plan to Advance Property Appraisal and Valuation Equity, or the Action Plan. So the Action Plan is a blueprint for how all Americans can benefit fairly from the equity built through homeownership. Specifically, the Action Plan outlines the historical role of racism in the valuation of residential property. It examines the various forms of bias that can appear in residential property valuation practices, and it describes affirmative steps that federal agencies will take to advance equity in the appraisal process, and outlines further recommendations that government and industry stakeholders can initiate. So the member agencies of the task force committed to a set of actions to help ensure that every American has a chance to build generational wealth through homeownership. The task force focused on identifying various concrete actions that agencies have committed to take to eliminate bias and advance equity in home appraisals. The full action plan can be found at pave.hud.gov/action plan. The task force has grouped its commitments into 5 categories. So these categories are strengthening guardrails against unlawful discrimination in all stages of residential valuations, enhancing fair housing and fair lending enforcement and driving accountability in the agency, promoting a well-trained, accessible, and diverse appraisal workforce, empowering consumers to take action, and providing researchers and enforcement agencies better data to study and monitor valuation bias. Please note that these commitments are actually commitments, and PAVE and the member agencies are fully committed to implementing them. So discriminatory home valuations, whether computed by an algorithm or conducted in person, undermine longstanding fair housing and fair lending goals. Discriminatory valuations can impact an entire neighborhood, distort the housing market, and in turn really impact the wealth of the homeowners in that community. We know that federal law forbids racial, ethnic, religious, and other discriminations in home valuations. But, however, for some home buyers and owners, a home's valuation can be skewed by one's skin color or the demographics of the surrounding community. It is illegal to discriminate against someone because of race at any stage of the mortgage process. This includes discriminatory property appraisals. So, unconscious biases may come into play when valuing a home based on factors that have nothing to do with the home's actual value. For example, an appraiser's use of or reliance on conclusions based on protected characteristics, regardless of whether the appraiser believes the conclusions are supportable, constitute illegal discrimination. So next, we'd like to present just a few examples of appraisal bias. For example, under or over valuation, where you receive a valuation that is under or over what market price should be. Using unsuitable comps or comparable sales. For example, using comps that are too far away, comps that have differences in property size or attributes. Adjustment discrepancies. For example, lot sizes, room counts in gross living areas, or factual or other errors that are listed on the appraisal report. So computer valuation models and algorithms are additional tools for mortgage lenders and appraisers to improve valuation accuracy. However, the use of AVMs, which are automated valuation models, may introduce risk, including issues with data integrity and accuracy. AVMs that reflect bias in design and function, or through the use of biased data, may introduce fair lending risk. And both in-person appraisals and appraisals conducted by algorithms undermine longstanding goals for fair housing and fair lending across our country. So we'd like to provide a little information on challenging an appraisal. Reconsideration of value, or ROV, allows certain parties to request that an appraiser reconsider the analysis and conclusions provided in the appraisal report. ROV can serve an important role in helping to ensure accurate valuations. More specifically, it refers generally to a variety of ways in which a borrower can ask for reconsideration of a valuation that they consider to be inaccurate. For example, ROVs can allow a borrower to point out factual or other errors or omissions, inadequate comparable properties, or evidence that a borrower believes indicates that an appraisal was influenced by a prohibited bias. The type of reconsideration available, specifically what it covers, and how to request may vary by lender, loan product, and other factors. So next, we'd like to turn to two tools in the CFPB's toolbox. First, we'd like to discuss Udac. The CFPB has authority under the Consumer Financial Protection Act to identify, prohibit, supervise for, and prosecute unfair acts or practices committed by any covered person or service provider in connection with any transaction for or offer of a consumer financial product or service. Discrimination based on group characteristics may be illegal, unfair, and harmful to consumers. Addressing such discrimination in the consumer financial marketplace falls within the CFPB's statutory mandate. More specifically, an unfair act or practice. Next slide, please. An unfair act or practice is one that causes or is likely to cause substantial injury to consumers, is not reasonably avoidable, and is not outweighed by countervailing benefits to consumers or competition. For example, if the act or practice causes harm to consumers, consumers cannot reasonably avoid the injury if the act or practice interferes with their ability to effectively make decisions or to take an action to avoid the injury, and if there is no offsetting consumer or competitive benefits that are also produced by the act or practice. Next, we'd like to turn to ECOA. A creditor, in certain circumstances, may be liable under the Equal Credit Opportunity Act for relying on a discriminatory appraisal. Regulation B, which implements ECOA, defines the purpose of the regulation to promote the availability of credit to all creditworthy applicants, without regard to prohibited basis. ECOA and Reg B prohibit discrimination against an applicant in any aspect of a credit transaction on a prohibited basis. ECOA, any aspect of a credit transaction includes the creditor's standards of creditworthiness, and standards of creditworthiness includes an appraisal if, based on its results, a creditor may approve, deny, or adversely modify terms of credit based on the results of the appraisal. Discrimination on a prohibited basis includes the race of someone requesting an appraisal or the race or other residents in a neighborhood where the property offered as collateral is located. So you can see how these two laws are within our toolbox. So next we're going to talk about the CFPB's work on appraisal bias. Here at the Bureau, there's a lot of work being completed on appraisal bias. The CFPB has really prioritized resources to focus on the role of racial bias in home appraisals. For example, the CFPB has engaged with other agencies on issues of bias in home appraisals through the PAVE Task Force. And aside from its involvement in PAVE, the CFPB is actively working with our interagency partners and with relevant stakeholders on this issue. Finally, we are working to provide resources to help ensure that the appraisals used to make lending decisions are accurate and free from bias. For my last slide, I'd like to provide just a little bit of information on filing a complaint. If you feel like you have been a victim of appraisal bias, there are resources that you can submit a complaint to. First, there's HUD's Fair Housing and Equal Opportunity Office. You can also contact the Appraisal Subcommittee, Appraisal Complaint National Hotline. And finally, if you believe that a lender has discriminated against you using an improper appraisal, you can submit a complaint to the CFPB. Thank you very much.
All right, thank you so much, Ms. Griffith, for the great presentation. I'm going to actually pass the mic on to DCRA, Mr. Leon Lewis. Now that you have the information that you need to file a complaint on the federal level, we think it's prudent that you actually have information on how to file a complaint with DC if you're a district resident. So Mr. Lewis, I'm going to hand the floor to you. You can expound on how to file a complaint with DCRA. Mr. Lewis, are you there?
Sorry, I didn't have my mic on. Can you hear me now?
Yeah, a little louder though, but we can hear you now. Perfect.
Okay. I'm Leon Lewis. I work for the Department of Consumer and Regulatory Affairs, more specifically the Business and Professional Licensing Administration, and with the Occupational and Professional Licensing Division. We support the work of the District of Columbia Board of Real Estate Appraisers. The Board of Real Estate Appraisers is a 5-member board composed of 3 industry members. They are licensed appraisers, and we have a real estate broker member, and we have a consumer member. The Board of Real Estate Appraisers meets every 3rd Wednesday at 10 a.m. All of our meetings are publicized via the Board of Ethics and Government Accountability. In addition to that, if you have any issues coming to our meetings, you can always use the website www.dcra.dc.gov/appraisers. We'll put that in the chat. And our phone number is 202-442-4320. The DC Board is governed by the Occupations and Professions Licensure Act of 1998 in compliance with Title 11 of the Financial Institutions Reform, Recovery, and Enforcement Act of 1989. We commonly call that FREA. The board's responsibilities include ensuring the qualifications of appraisers are in compliance with the Appraisal Qualifications Board of the Appraisal Foundation, which was established right after FREA was actually enacted. The board regulates the practices of all appraisal licenses in compliance with the Uniform Standards of Professional Appraisal Practice, and we commonly call that USPAP. That's a set of standards that's established that all states and jurisdictions must follow. The district disciplines appraisers who are in violation of the licensure law and regulations, and it regulates the approval of all appraisal courses that appraisers must take. As mentioned earlier, the board meets every Wednesday at 10 a.m. And at that meeting, they have an agenda where complaints are usually reviewed at every meeting. The website, again, for filing complaints is www.dc.gov/appraisers. And your complaints will be heard by the District of Columbia Board of Real Estate Appraisers. So when you go to that website, you can click on the tab Consumer, and then that'll lead you to the complaints section where you can actually write your complaints, and then the board will receive the complaints at their meeting, at their respective meetings. And basically that's it from me.
All right. Thank you, Mr. Lewis. All right, thank you again. All right, so we want to give a big thank you to all of our presenters today. Definitely a lot of information packed in within an hour. We will now enter into our question and answer segment of the forum. Miss Mia Cole will be she's a member of the subcommittee, and she'll take the reins from here to handle the Q&A segment. Thank you.
Thank you, Monique. Good afternoon, everyone. As Monique stated, my name is Mia Cole, and I am a bank examiner with the Department of Insurance, Securities, and Banking, or DISB. Throughout the presentation, we see that some of you have already begun to put questions into the chat feature. So I will read the questions out loud so the presenters can respond. If you are joining us by phone today, please press *3 to raise and lower your hand. We will work to unmute your line to verbally ask your questions. Okay, let's begin with the Q&A. So far, it looks like we have approximately 3 questions. So I will begin with question number 1, and this will be directed to Dr. Neer. Actually, the first 2 will be directed to Dr. Neer. Sorry, Mr. Neer, Dr. Neer. And the first question is, with regards to the appraisers, was it federal appraisers or federal regulators?
I think the answer to that question is it was really the Federal Housing Administration who was responsible for determining whether to insure the loan, who was deeply sort of involved in assessing valuation, in appraising the property. I think is the answer to that question. So the government agency responsible at the time was the Federal Housing Administration.
Okay, thank you. On to question number 2. Is it possible you can elaborate on the appraisal book known or referred to as the Bible of Appraisals?
Yeah, I mean, it's my understanding that McMichael's appraising was one of the foundational texts that was utilized by appraisers in determining how to value properties. Now, I think it unlikely that it was the only text, and there were probably numerous different or reference materials utilized for the valuation process, but I have seen that particular one routinely referred to as the Bible in having widespread influence at the time. There are obviously probably numerous reference sources that appraisers use to conduct valuations, and that was certainly one important one at the time, sort of back in the 50s.
Okay, thank you, Dr. Nair. Question number 3, we will refer to Ms. Michaelia Griffith. Maybe you can elaborate on who decides market value. Coupled with that question, how would you identify if you are undervalued or overvalued compared to the market value?
So I can address the first question. So market value is essentially the price that the market will bear to the price that the market would bear. So it's the fair market value of a house that a consumer or a buyer would pay for your house. Regarding how to identify if your house is over or undervalued, I would urge you to look at the pay report. I can put the specific link in the chat box here that may give you a little more insight.
I think the other thing that I would add to that is, we've seen, I think, numerous press reports citing sort of very clear instances of what looked like potential appraisal bias or discrimination, where an African-American homeowner would get an appraisal, and then essentially it would come in low, and then they would, what I've heard referred to as whitewash the home. In other words, move all pictures of their family or anything related that would signal sort of their racial identity. And then subsequent appraisals have then come in at consistently higher valuations. So, when we see that in the press and hear reports of that, I think that leads us to conclude or think that there may be sort of inherent problems in the valuation process that are not impacted by the market itself, but rather through potential discriminatory animus, be it conscious, unconscious. And the PAVE report, I think, does a really good job of sort of laying that out in a lot of detail.
Okay, thank you. The next question we have will be directed again to Mr. Neer. When was this text published and is it still being used? Another one is the Bible still in use today?
A good question. I don't know, to be honest. I know we have a number of appraisers on this call. I am not sure if that particular reference source is still used, or if it has been replaced by other material at the time. But a good question. I'm not sure is my answer to that. All I know is it was certainly a prominent reference source a number of decades ago. Whether that continues to be the case, I'm not sure. But there were multiple editions published of that particular book, and it was used widely. Over time, perhaps it has been replaced by a different source. But
I wanted to add to that from a regulatory standpoint, the current Bible with a small b is the Uniform Standards of Professional Appraisal Practice. When the board meets every third Wednesday, that's those are the standards that the board uses in evaluating appraisals when complaints come in. That's sort of their Bible with the small b with regard to evaluating appraisals and whether the appraisals are in compliance. That's what they use. That's the book that's published every 2 years. They go through that book every 2 years. They review it and they add to it or delete any standards or any form of verbiage that may be outdated. But the current USPAP book represent the standards that appraisals are governed by and is used by the boards, the 50 states and jurisdictions. That's what they use, and that's the USPAP standards.
Okay, thank you, Mr. Lewis. Mr. Neer, would you like to add anything further to the response?
No, I think that's very helpful. As I mentioned, there are certainly multiple reference sources. That is one that was prominently used back in the 50s. So it certainly sounds like there are newer, more recent documents that are used for conducting appraisals.
Okay, thank you. We will move on. I believe this question should be directed to Ms. Michaelia Griffith. Based on all of the information we have with the PAVE task force and additional studies, what is being done to update the USPAP standards and continuing education courses to address some of these problems, or at the minimum for heightened awareness of appraisal bias?
So that's a really good question. I do not know if folks are aware, but the National Fair Housing Alliance published a report, I think last January, probably, and it really spoke to this question, provided specifics about, provided recommendations, and really talked about, barriers to entry in the appraisal profession, also talked about USPAP, also talked about specific classes that appraisers have to take. I will say that the Appraisal Foundation is the person responsible for updating USPAP. We at the CFPB do not have any real insight into that process, so that is a question that I could not fully answer.
If I can add to that, USPAP is normally evaluated. It's published every 2 years. There are amendments to USPAP that's published every 2 years. There's a current edition out now. With regard to fair housing, I know the USPAP course, there's been an addition to it with regard to fair housing and bias. So USPAP again is that Bible course with a small b that all appraisers are governed by with regard to the practices that they're engaged in. But they did add an additional section to USPAP for this year and moving forward.
Okay, thank you, Mr. Lewis. The next question, possibly Ms. Michaelia Griffith or Mr. Lewis can chime in with regards to a question regarding federal oversight. Where do practicing appraisers find a resource to issue complaints around regulators and regulations that discriminate, cause barriers to entry, and cause anti-competitive practices against women and minorities?
Well, I do know from the regulatory standpoint of appraisers, all complaints are reviewed by the board. As I mentioned earlier, they meet monthly. Most boards, they meet monthly. And all the complaints are evaluated by that board. We haven't received any bias complaints that I'm aware of, but if there are bias there, they would review the complaint. And in some instances, I work with a number of boards. Some of the complaints are referred over to the Office of Human Rights. So, in the district, we work in conjunction with the Office of Human Rights. But for our board, we haven't received any bias complaints. The complaints that we receive so far, and I've worked with the board since 2007, and they're in the area of USPAP possible violations.
Okay, thank you. We still have quite a few questions coming. Oh boy, we have quite a few questions coming in. I hope we can get to still get to a lot of them today. The next question is, Mr. Neer, have the reports, and this question doesn't specify which reports, but have the reports in the press been actually reviewed by qualified professional to determine the outcomes of both appraisals? I'm assuming they are the appraisals where there are disparities in those appraisals.
I don't have any personal knowledge of involvement in any of the press reported complaints. I certainly know there has been legal action, I think, taken at least one of those in Indiana, and there has been complaints filed sort of based on that particular episode. But I personally have not been involved in any of these complaints. But that's not to say that folks have not availed themselves of the various complaint processes that are available at HUD or with the Bureau or filing private legal actions if those are warranted. I certainly have seen that documented, at least one of the complaints that the person who felt aggrieved did in fact commence legal action against potential appraisal bias.
Okay, thank you. I will pose this question to the general panel. Have these claims in the press been verified as accurate and addressed with the appraisers by the states and or the FHA, Federal Housing Authority?
Well, with respect to the DC board, when complaints are received, and there are violations, the appraisers, they have an opportunity to respond to the complaint. And if there are violations, then sanctions are imposed against the respective appraiser. And I can tell you, that has happened, with our board over the years that I've worked with them. I don't know whether that addresses your question, but the complaints are received, and the respondents, their appraisers, have an opportunity to respond. Appraisers are reviewed thoroughly by the board and our review appraisers.
Yeah, I think I would agree with Mr. Lewis that there are processes in place that if someone feels that they have been discriminated against, they can file a complaint with any number of agencies who then have internal processes for investigating those to determine whether there was unlawful discrimination. And that is typically done through an investigation, interviews, document reviews. It's a fulsome process that seeks to determine whether there was discrimination. I don't think anyone on this panel has been individually involved in any of the complaints that we've seen in the press. But that is sort of a general process that people who feel they have been the victims of discrimination can avail themselves of in terms of filing a complaint, and a government agency will then investigate those allegations to see if they have merit or not.
Okay, thank you. On to the next question. And this I will pose also to the panel. How does a consumer or regulator determine if the value is accurate, inaccurate, credible, or not credible? Thank you.
Again, from my side, with working with the board, those complaints are reviewed by the board, and if the board is of the opinion that it warrants a review with regard to a review appraiser, then that person evaluates it and gives a report back to the board for consideration. And then the board makes a determination as to whether sanctions will be imposed on the respective appraiser.
Okay.
Yeah, I mean,
Like-
what would typically happen in the context of a discrimination complaint is an investigation would seek to determine whether there was differing treatment between white and black mortgage applications in properties. So, it would be evaluated in the context of a legal framework known as disparate treatment to determine if there was potential discrimination. And that generally is driven by an analysis of similarly situated applicants. You would evaluate how an African-American borrower or a home in an African-American neighborhood was valued in comparison to a similarly situated minority or white applicant or a white neighborhood. That's traditionally how discrimination investigations have unfolded. So it's not seeking to determine whether the property was necessarily valued correctly. It's looking to see whether there is differing treatment in how properties are valuated, sort of across racial and ethnic lines.
Thank you, Mr. Nair. And some of your response can probably be applied to this next question. However, the next question states, how can this be appraiser bias when the appraiser is reporting the actual actions of buyers and sellers in the actual market that the public is participating in?
Well, again, with the board that I work with, it's pretty much about the uniform standards. They evaluate complaints and compliance with the uniform standards. So, I can tell you that, and then that's what, and they do that very accurately.
Okay, thank you. Mr. Lewis, we have one for you. Is it possible you can give an indication of the number of appraisal complaints received on an annual basis?
Yeah, it varies. With the district, which is a smaller population than the states, we have anywhere roughly from 700, close to 700 appraisers in the District of Columbia, at all levels. And we may get 15, 20. I don't have the exact number. It varies. It's up and down. They evaluate every complaint that comes in there. So whatever number comes in, they evaluate the complaints in compliance with your staff. I'm sure a lot of the larger states, if you talk about California, Florida, Ohio, or some of the larger states, you're going to get a lot more complaints because there are a lot more appraisals done. But for the district, which is sort of on the smaller side, you would have a smaller number of complaints. But when the board receives them, they evaluate each one of them with considerable review accuracy.
Okay, thank you, Mr. Lewis.
Just one quick caveat to add to that too.
Yes.
I believe that we should actually make sure that folks know that there are places that they can go to, report these instances. And I provided that on the last page of my slide because we actually do want to hear about any complaints or any instances that may have happened.
Okay, thank you, Ms. Griffith. There was a comment in the chat that says that I would like to see an appraiser on the PAVE panel and also on this and any future courses to give the perspective of an actual appraiser in the field. Let's see, I believe we have time for one more question. Mr. Lewis, is there any feedback from the 50 boards on the content of the classes and USPAP standards?
You mean responses from the attendees? Is that the question? I'm sorry. Hello?
I believe the board members on the content of the classes and USPAP standards.
Well, it's a standard course, and they have a pre-licensing course. That's a 15-hour course, and then they have the 7-hour update course. So the course is built around the current USPAP standards. If that answers the question. The board itself gives a course every 2 years now. We gave the board sponsored one last December, and they go over all aspects of USPAP. So that's given by the board every 2 years. I don't know whether that answers the question, but that's the board's one of their responsibilities is to they've taken it on and to give the appraisal licensees that course in addition to the delivery provided by the approved sponsors of the course.
Okay, thank you. I'm sorry, we do not have time for the rest of the questions. However, if you'd like to, we can forward these questions, or if you'd like to ask these questions, you can please forward your questions to either DCRA, that's the District of Columbia Department of Consumer Regulatory Affairs, especially if it refers to anything in the district, the CFPB, Consumer Financial Protection Bureau, or here at DISB, the Department of Insurance, Securities, and Banking. We would like to thank, the next slide, please. We would like to thank our partners, Mr. Charles Nair, Ms. Michaelia Griffith, from the CFPB for partnering with DISB and providing this important information to district residents. We'd also like to thank Mr. Leon Lewis and DCRA for their contributions to this effort, the DC Department of Disability Services for providing a sign language interpreter for this event, and most of all, thank all of you, the participants, for your great engagement and questions and joining us on today's forum on racial bias in the home appraisal process. In closing, we would like to reiterate that this presentation was recorded. If you missed any part of the presentation or would like to listen to it again, it will be available for playback on our website at www.disb.dc.gov within the next couple of days. And again, if you'd like to file a complaint in the District of Columbia, please go to dcra.dc.gov/appraisers. We hope you enjoyed the presentation, and to stay informed about the great work that we are doing here at DISB and for upcoming events, please follow us on LinkedIn, Facebook, Twitter, and YouTube. On behalf of DISB, thank you again for joining us, and this concludes today's presentation.